Having a game plan for understanding what is the best way to withdraw money out of your accounts post selling your business during retirement is going to be critical as it relates to both taxes and maximizing the value of your estate over time. Two key things. The first thing is we have retirement accounts and we have non-retirement accounts. Retirement accounts are accounts that we funded throughout our careers, pre-tax dollars went into these accounts, you invested it, it grew to a certain value to where it is today. In our taxable accounts, those accounts that we invested after tax dollars, and that was invested and that also grew and compounded at a certain rate of return. So when you retire, you have both of these accounts funded with a certain amount of dollars. And the question is how should I withdraw from these accounts? If you get this right, you could really save tons of taxes over a lifetime. So if you think about it, if you sell your business at 60 and you live to 95, well, over that 35-year period, because you executed the strategy correctly in terms of withdrawal, you really saved your family tons of taxes throughout that process. As I say all the time, it's not just about your investment selection and the growth of the investment selection, but taxes play even a more important role oftentimes. Many times people are too short-term minded. Where they retire, sell their business, they'll have X amount of dollars in the bank, and they'll say, okay, well, I have $300,000 in the bank. The rest is invested. I'll withdraw money from that account, and then I'll worry about everything after that. So they're not really thinking over the long term. They're being very myopic in their thought process. So the idea is to say to yourself, okay, if I'm 60 years old today and I live to 95, what's going to be my exact plan over the next 35 years as it relates to the accounts that you currently have? The idea behind setting up a long-term plan is you want to set up a plan just like when you were working. So if you owned your business, you were probably receiving some type of income once or twice per month, much like your employees. And then at times you took out a large amount, maybe on a quarterly basis. So perhaps you set up a system that you've been used to for so long, and you could simply and easily do that by setting up the right plan. The biggest question many people have is, okay, I sold my business, I have all this money. Well, how am I going to start to receive an income stream? Where am I going to withdraw the money from? It gives a lot of people a ton of anxiety. So the first step you have to really think about and say to yourself is, what income sources do I have coming in that will help pay for my actual lifestyle? And is there any type of gap? So before you think about your portfolio assets, ask yourself what that looks like. So here's an illustration of a hypothetical client, and their names are John and Samantha Jones. John's 61 and Samantha's 59, and they're looking to retire at the age of 61. So John will be retired at the end of this year. Samantha will still have another year or 2 years. Their income coming in will be Social Security of $33,000 and $30,000 at 67 years old. So if they retire at 61, they have to fill that gap that Social Security will not have until that period of time. So John will receive Social Security of $33,360. Samantha will receive $30,000, but that's not until 67. So from 61 to 67, we got to really make up that difference. And then John and Samantha has consulting income of about $50,000 that they will receive pretty much throughout most of their retirement years. They also own a real estate property that will also bring in about $50,000. So their actual expense need is about $250,000. So there's a good amount of income that will be coming in after 67. But in the meantime, between their consulting income and real estate income, which is 100 grand, they need 250. So they're short about $150,000. And which will they be dependent on? That's when your retirement and non-retirement assets start to come in play. So step number one is understand your income sources. Number two is understand the income bucket approach. The key thing to this approach, it's a psychological benefit, because what you are doing is you're compartmentalizing your assets in three separate buckets. As you can see in this illustration, the idea behind this is you have these three separate buckets, like I just said. And bucket one is what I call your liquidity bucket. So that's what you're going to do to fund 3 years worth of your expenses. So in this example that I just gave you, where this couple is spending $250,000 a year, they have $100,000 coming in for consulting income and real estate income. So the gap is $150,000. So $150,000 goes into the liquidity bucket times 3. So that's $450,000 that you put into the liquidity bucket. And I'd probably put in about $50,000 more for unforeseen expenses and for any inflation. You could even put maybe $75,000 more. And that gets invested in treasury bills going out 1 year, 2 years, and 3 years. So every year you have a treasury bill coming due, which will replace the income that you're going to need year after year after year. Now, in the core bucket, you're going to fund the core bucket with enough money to carry you through the age of 95 years old. So the core bucket then is going to replenish your liquidity bucket for the next 3 years. So every 3 years, you're going to replenish the liquidity bucket. So the idea behind this is pretty simple, is that you know that you have 3 years worth of income locked in for that period of time. So no matter what's going on with the core bucket, which typically are investments that have volatility and fluctuation, which makes people nervous in retirement, well, you don't really have to worry about the core for 3 years. And that's the beauty behind that. Because if you go through an economic downturn or some type of market meltdown, you know you don't have to worry about that for 3 years, which gives you enough time to make that back when you're going to need that money. Now, if you're a conservative investor, you could say you could put 5 years worth of money into the liquidity bucket. The negative in doing that is you're going to get a reduced rate of return on your total money. But if that's something that makes you feel better and the analysis proves you can afford to do that, I would go ahead and do that. Now, what I recognize throughout my career is that most of the time, people are not going to spend 100% of their money all throughout retirement. That means there's money that's going to be left over for children, grandchildren, or other things that you may want to do, which I call the plus bucket. So as you can see here, the plus bucket is for luxury or legacy. So if you're thinking about buying that second home or maybe third home, or legacy planning and transferring money to your heirs, both children and grandchildren, while you're alive is important, whether it's funding education, helping a child purchase a home, weddings, whatever it may be, you can now plan for that accordingly. The first step to funding the plus bucket is really getting a handle on and going through the analysis to understand, well, what percentage of my money am I not going to spend throughout my lifetime? And if it happens to be the money that's in your Roth IRA, well, that's really ideal for legacy planning because it's tax-free growth and it's never, ever taxed. So this is a great way to think about bucketing your money and planning for your money's distribution over a long period of time. And then the third area to think about is asset location and taxes. So we have the bucket approach that we just discussed, but now you got to say to yourself, well, which accounts am I going to put in which bucket and where am I going to withdraw from first out of my accounts and withdraw from last out of my accounts? There are certain analyses that you can run to understand how to optimize your specific situation. Sometimes it may make sense to pull 10 or 20% from your qualified accounts and the rest from your non-qualified accounts. The ideal way to do it is to withdraw money out of your non-retirement account, and then your retirement accounts last, or when it's mandatory, you have to take money out, which is at age 73, which probably will climb higher over time. So to go back to my illustration, an example of both John and Samantha Jones, first, to give you the facts are they have assets, right? They have cash alternative assets of $1 million. They have taxable investments of $1 million. They have a qualified retirement account for John of $2 million and Samantha of $2 million. So these are the liquid assets that we will pull from first when it comes to planning for this couple. So the first step is to look at withdrawal assets. So when we look at their actual cash flow, not including their real estate, what this particular analysis will show is the flows that are coming in, which if you remember was the consulting income and the real estate income, which is 100 grand. Their total expenses are not just 250 because you have to factor in taxes when you withdraw money out of various accounts, or in this case, they are earning income for a year or two. As I said, the wife is 59, who's retiring at 61. So she'll work for a couple of more years. So there's some additional taxes that we paid. So that's part of your overall expenses. When we look at these inflows and we look at the total outflows, we want to understand where are those outflows coming from. So when I simply go into this tool and I click on withdrawals, this helps me understand how to optimize withdrawals from a tax standpoint. So ultimately what we're going to do is we're going to withdraw money from their cash alternative account that I talked about before for the first, call it 6 years. And then we start tapping into the taxable investment account, right? For the next, call it, 7, 8 years. And then after that, there's going to be money coming out of the qualified retirement account because of required minimum distributions, and that will start to fund their lifestyle. So 250,000 today, they're going to need more 5 years from now, 10 years from now, and 15 years from now. But the way to withdraw money out of these various accounts are exactly what you're seeing here, which we're tapping into non-retirement accounts first, then the taxable investment account, and then into retirement accounts. And that's the ideal way to do this to really reduce overall taxes. To give you an idea from a tax standpoint, what you have to be thinking about, when we run this analysis for the same exact scenario for both Samantha and John, the first couple of years, their effective income tax bracket. Now, your effective income tax rate is your total gross income minus any deductions you have. And then you have the baseline taxable income, and then you take out the actual brackets, and it gives you an idea what your total tax is going to be. You take your total tax, divide that by your gross income, and then you get what's called the effective income tax rate. So from a planning perspective, it's really important to get this right, because if your tax analysis is wrong, your end number in terms of the potential legacy down the road, or even the idea of running out of money, could be completely wrong. So getting these figures right is important. Just a quick side note, best way to do that is look at the last 2 years of your overall taxes and what you paid in taxes, your deductions. And if you're just retiring now, obviously that's now going to change going forward. So coordinate with your CPA to really understand what your overall tax rate is going to be. Help the CPA understand where you're going to be withdrawing funds from and what the overall tax rate of that's going to be as well. Any interest, dividends, or any potential capital gain. So do a thorough analysis with your CPA to really understand what these effective income tax rates are and if they are in fact correct. So in this situation, when they're fully retired, we have an effective tax rate of 21.99%. This can be 30%, 35% if we withdrew money from their retirement accounts. And if we continue to do that, right, these next few years here, that could increase their overall taxes they're going to pay. And that's when I start off by saying, if you don't understand the best place to withdraw money from to save taxes, it could really hurt you in the long term for both growing your wealth and savings and overall taxes. So doing this tax analysis is going to be critical in understanding where you stand from a standpoint of withdrawing funds from your overall account. So the 3 critical things to think about as it relates to withdrawing funds from your various accounts is, number 1, understanding what are the income sources that you're going to have. Are they reliable income sources? And are they going to be consistent? Once you understand that, then number 2 is you have to understand what your income gap is. So if you have 100,000 coming in, your expenses are 250, well, there's a gap of $150,000. So once you understand that, then you can understand how much to fund your liquidity bucket. If you remember, there are 3 buckets. There's the liquidity bucket, there's the core bucket, and then there's the plus bucket. So you can understand how much to fill the liquidity bucket with once you understand your income gap. And you fill that bucket with either 3 years worth of spending and some money for inflation and unforeseen expenses, or you could do it over a 5-year period. And you invest in treasury bills. And then you fund the core with enough capital to fund you until age 95 years old. And then the plus column, like I said, that's for money for luxury and for legacy planning. And the third part is asset location. So where should you pull this money from with the various accounts you have to save in taxes, which will help grow your wealth over long periods of time as well. Financial stability is not just about growing wealth. It's about simplifying and organizing and always understanding your next move. And when you do that, that actually will help grow your wealth over time. This is all about creating financial peace of mind. When you understand what you're doing, it really brings down the anxiety levels. And that's what we're trying to achieve together. So if you like what you hear today, like below, insert any comments of any questions you have, and I'll be sure to answer them as quickly as possible. Thank you for listening in. My name is Philip Palumbo, CEO and founder of Palumbo Wealth Management.